being a contrarian trader, betting against the trend, you're going to get run over. It's just like standing on the train track, looking at the train and saying, no, you need to turn around. Just stop right there and turn around. But what's going to happen is you're going to get run the hell over, and you're going to be laying on the tracks going, oh, maybe I shouldn't have bet against the trend. My name is Chris Fuel. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where we save time, make money, and start winning with less risk together as a team. Now, let's get into the lesson of the day. So be sure to stick around to see how we rank this out of 10, and subscribe if you haven't done so already. So we're going to be watching this video called Bears Are Being Tricked and Trapped. The trap is set. All right, let's see what they have to say here.
All right. Today I want to do a special update about whether or not we are entering a bear market. And the answer is no, and I'm going to...
Okay, so far, off to a bad start. Whether or not we're entering into a bear market. So the bear market is considered a 20% correction from all-time highs, right? Now, the only way that you can get that is if stocks are trending down. That's a fact. We are already trending down, right? So if you've watched any video from me before, you'll know the outlier trend template is the 10 period under the 20 period with price under the 50 period. So your short term, your intermediate term, and your long term all stacked pointing down. And that's exactly what we have here. Does that mean that we're going to hit a bear market? I'm not sure, but we are trending in that direction. Now, where would a bear market be? Let's do the math real quick on this. So bear market would be down 20%. A 10% pullback is a correction. So 10% gets us to 545 on the SPY from all-time highs. 20% puts us at 483 from all-time highs. I mean, that would be a tremendous drop, but we're already down about 5%, getting close to 5% at this point. So I'm not saying that we're hitting a bear market, but I am saying we're definitely in a bearish trend right now. And that should be forefront of your mind.
To talk about why I still think 2025 is going to be another bull market year. Even though we're not looking for some crazy plus 25% bull market year, I still do think we're going to have positive returns in 2025. And I'm going to talk about exactly all of the things people are getting wrong. 2025 video, there's going to be plenty of people calling for tops, calling for bear markets. These are the same people who have been calling for bear markets even in 2023 after we already had a bear market in 2022. And it's very dangerous to assume during a pullback within a bull market that you're entering a bear market because that is the lowest probability chance. And you don't just...
I agree with that, right? Longer term trends play out, right? If we zoom out and go to like the monthly charts here, right? You can see a super strong trend on the monthly charts. But if we're looking on the daily charts, we definitely are in a bearish trend at the moment.
Just get bear markets every 2 to 3 years. They're very rare and they're very hard to come by. And that is because money is always looking for somewhere to go. So the first thing we need to look at is SPY. A lot of people are freaking out because we did get a lower low breakdown. So without a doubt, if we're just looking at the daily chart of SPY, we can see lower highs and now what are looking like lower lows down below 584. So without a doubt, this is a pullback within a bull market. And without a doubt, this pullback could go a little bit lower. And I do want to switch it over to the weekly chart because on the weekly chart, you need to see that we're at the rising 20 period moving average, which is right around the 580s. We do have this lower high and now what looks like another lower high rejection to a lower low, which is breaking down. And while that is coming into support, this is no different than what we saw back here in 2023. If you remember back in September, we started to break down to a lower low on the weekly chart. A lot of people were starting to call for this being another bear market. And that's why I said these bears have been around since even 2023, saying this was another top and that we were just going to continue to crash.
And he's got a good point here, right? It's all about the trend, right? Hindsight's 2020. But in the moment, like as of right now, you need to have risk on the forefront of your mind. Risk meaning if I don't already have profits in my plan, if I don't already have an exit strategy all set in stone and what I'm going to do, now's probably the time that I need to be doing it. If I haven't done so already, I need to have been doing it as soon as yesterday, right? And this may be a lot of risk for a lot of people here when that market is pushed up as high as it is. Now may be the time to say, you know what? I'm going to take a step back, right? The SPY's lost its 50 period moving average. The 10 has crossed under the 50 period moving average. There's nothing bullish about this at the moment. Not at all. But that doesn't mean it's going to crash. And that certainly doesn't mean that it's going to just rocket ship back up like we've seen the last couple of years. You need to have risk at the forefront of your mind. And this right here, this setup right here is very bearish. Okay. You need to keep that in mind. I don't think bears are being tricked. I mean, mathematically speaking, the average of these number of periods is moving down. It's just math, okay? And you can't argue with the math here. right? The math is pointing to a bearish trend. Where is the bottom? I don't know, right? It could be down here at this level at 550 or so. This is an order block that was created in September. So this order block right here basically says that there's large institutional orders waiting to be filled. And it honestly works as the best support and resistance I've ever seen ever on any chart. So if we get down to the 550 area, I would absolutely look to see some bounces at that point. But what would that be? What kind of pullback would that be? About a 10% pullback, which would scare a lot of people, scare a whole lot of people.
Down. They were saying that this was a lower high after the 2022 bear market. They were saying this was just a bear market relief rally. This was a lower high and we were just going to continue down and continue crashing. And that would have been the biggest mistake you could have made, because from there we went on another bull market rally of over 40.
Right. But you don't know that, right? When you're looking at this, right? In fact, let's do this. Let's take a little screenshot of this, right? When you're in this moment, okay? When you're in this moment on this candle right here, you don't know what's happening next. You don't know that it's going to go up 20% for the year. You don't know that, okay? So you need to keep risk as the forefront. The most important thing on your mind should be, okay, I see this is moving down. I might take a short. I might be out of my long positions, or I might just be in cash, right? I've been in cash since basically right after the elections. And looking at the data right here, I would either be short or in cash. That doesn't mean that we can call market tops or call market bottoms, but you've just got to always be risk first.
30% gains, and this is from the September breakdown. We had even more profit if you were coming off the October lows of 48%. So this is the danger with just believing people know what they're talking about when they call for a bear market. Yes, we need to respect the fact that risk is increasing as we get lower highs and lower lows, but it doesn't necessarily mean that people are going to be able to already say it's a bear market or a bear market coming. And I'm going to give you objective reasoning on why it's very unlikely we're going into a bear market. So on this daily chart, all you need to do is just manage risk down below 584. If you do not want to buy until we get back above,
manage risk below 584. Hang on, where's that at? So 584, that right there, 584.50. So I'm not sure where he's going with manage risk below 584. Does that mean take profits off the table, take your positions off, go to cash? I'm not sure what he's trying to say with that, but completely agree with you need to always be risk first.
Above 584, it is really just as simple as getting risk off until SPY can get back above 584. Now, while we're below 584, the most likely probability is that we would come down towards a gap fill at 576 and then a support zone right around 570.
Okay, 576 is right here. So he's saying working off that candle back there.
And then once we got there, it is possible that's another higher low within a bull market, because if you zoom out, all of these lows are all higher than the previous lows, and this would still be a higher low from the low back here in the 560s. And that means at any point this pullback could end and we could go on another very violent bull rally, which could take us to another brand new all-time high in the 600. So do not rule this possibility out. I'm going to talk about why this is a very good chance and why this is more than likely just a pullback within a bull market. And the first thing we need to look at for that is the bond market. So I'm going to pull up TLT because this is a longer term bond. This is the 20-year treasury bond. And as you can see, this thing is down in the dumpsters from this high back here in September 2024. TLT is down about 15%. Now, if you remember back to 2022, I'm going to give you a quick history lesson, is that bonds were trash because even though we had fears of recession, we also had very high inflation. And when you have high inflation, you do not want to own government debt. And that is why in 2022, we had an inflationary bear market where even though companies were still doing all right, making money, the stock market was going lower because we had very high inflation. Now that inflation is coming down, we still have bonds going lower, which is telling us there's no fear of a recession, because in a recession, bonds do very well. So really what you have to think about here is the fact that the bonds are still doing poorly is because people are still concerned that inflation may return back and we may get another inflationary bear market, or at least inflation that's going to cause the Fed to have to act and possibly mess around with rates again, which is obviously bearish for stocks and bonds together. Now, when I look at the bond market, what I see is very...
Oh, hang on. Messing with rates, right? Messing with rates has not been all that bearish, okay? I mean, just zoom out and you can say, oh yeah, when Jerome Powell started hiking rates, it was supposed to be the end of the stock market, right? That's not been the case. Definitely not. In fact, I do a lot of consulting with financial institutions, and one thing that we talk about a lot is rates going up or down, and the historical correlation of, oh, if rates go up, then that's going to push the market down, has not held true. Has not held true at all in this last cycle here.
near a bottom, because as you can see here, volume is starting to increase as we're getting buyers of the dip, which increases the probability. I think the bond market is going to start to bounce here, which does go hand in hand with an end of the month rally with FOMC and also the inauguration of the brand new president, where confidence could come back to the bond market, and that could carry over to the stock market as well. But if money is leaving the stock market and we're going into a bear market, you can clearly see it has not yet started to go into the bond market yet. So do not have concerns there. There's nothing in the bond market that tells us money is pouring into bonds and that stocks are going to be weak, because if we saw stocks selling off while the bond market was rallying, that would be a lot more concerning that smart money is starting to sniff out a recession, but we just don't see that yet. And if we look at the total Fed assets, we can see that even though the Fed was reducing rates going all the way back to 2022, the Fed has actually already reduced their balance sheet by $2 trillion from the highs back here in 2022 to now all the way down here in January of 2025, $2 trillion less. And you could see there was a little bit of a spike here in March of 2023, and that is when the regional banks were failing and the Fed did have to bail them out. But as soon as they bailed out those regional banks, they immediately started to reduce their balance sheet yet again. So with the Fed reducing their rates, they're more than likely going to start pausing. They're still tightening because, as you can see, they've reduced their balance sheet by $2 trillion. So even though they did reduce rates a little bit, they're still overall worried about inflation. And that is why they're still not stimulating. They're still pulling money out of the system, which is going to help keep inflation in check. So the best thing the Fed can do right here is just sort of pause and let the market digest everything that is going on. And as you can tell, a very important part of that will be the bond market. So pay attention to TLT. If TLT starts to bounce as I'm expecting, that is going to bring rates down. And as rates come down, I do think we're going to see a rally in the stock market.
I'm glad he's going through this, because this is stuff I don't look at all. So I appreciate his analysis here on the bond market.
So when I go back over here to SPY, that does look like very similar to what I drew, is that even if we get a little bit more pullback, this is not the start of some nasty bear market. More than likely, we're just getting an early year pullback. This is causing lots of...
I think you're doing a disservice by saying, don't be scared because it's going to go up from here, right? In my opinion, and this is just my opinion, right? When you see the market selling off in one direction, right? When the trends are all pointing in one direction, I think it's best in my mind, at least, best in the market wizards that I learned from, at least, to continue on that trend. Okay. Yes, there will be a point in time where the trend bottoms, but to call it and say it's not going to happen, right? I think that is I don't know. I think that's giving false hope, because what do you have to base that on? Price is all that pays, right? And there may continue to be a correlation between bonds and stocks here, but then at the same time, that correlation may dissolve, right? That's not a perfect correlation. In fact, we've seen many times where that correlation has broken, where bonds and stocks just move independent of one another. So I don't know. Looking at this chart, I'm very bearish. In fact, if I go into outlier here and I look at the SPY, it still has a sell signal that came through on November 26th, right after the elections. So we got that sell signal here, and it's moving more and more and more into the fearful area right now. If you remember, Uncle Warren used to say, be fearful when others are greedy, and greedy when others are fearful, right? People got really greedy around December, mid-December in the SPY, and it's really sold off hard as far as the fear and greed index goes in here, and it's been pushing decently into the fear. Now, one thing that I will say does give this a little bit of credence that maybe we'll hit a short-term bottom here in the near future is market breadth. So the way that we measure market breadth is how many stocks are getting a buy signal versus a sell signal. You can see there's more stocks, the green line right there, getting a buy signal inside of our program, inside of Outlier, than stocks getting sell signals, right? So we're moving up that list of buy signals, and it's crossed over the moving average of that list right there. So the market breadth is coming back, but we still have a sell signal on the market, and the market is still trending down. So for me, it's a risk off position for me, right? Because I want to see breadth. I want to see trends both moving in the same direction. And until that point, I sit in cash, and I can sit in cash for weeks or months at a time. And it's not going to hurt my feelings to sit in cash until all of it clicks together, and then I make money hand over fist. It just gets really, really easy to trade when you wait for the market breadth and the market trend to work together. When you do that, it's just like shooting fish in a barrel. It just gets so much easier.
Of fear and lots of people to panic, and that's why people are even starting to call for bear markets. And it is then when everybody is freaking out that we are going to get a really nice rally, and then a lot of people are going to be too scared to participate in it, and they won't actually make any money. And even worse, some people may even try to short here, and then they're just going to lose money as the market rallies off of the support zone. So what I'm trying to tell you in a very long-winded way is that I am still going to be buying the dip at support levels. I still do believe this is a bull market. It is very low risk because we're not getting...
Don't ever buy the dip. I know that's like the general knowledge, right? But don't buy the dip, okay? here's a piece of wisdom that you can take to the bank. Okay, the market's going to tell you when the dip is done, but if you decide that you're going to start buying it contrary to what the trend is doing, being a contrarian trader, betting against the trend, you're going to get run over. It's just like standing on the train track, looking at the train and saying, no, you need to turn around. Just stop right there and turn around. But what's going to happen is you're going to get run the hell over, and you're going to be laying on the tracks going, oh, maybe I shouldn't have bet against the trend, right? Where the moving averages will start crossing back, right? And you can see it right here. Like, this is a great example, right? There's going to be a point where it closes on the other side of the moving averages, and then the averages are going to start trending the other direction, okay? That's when the dip may, because anything can happen on any day, that's when the dip may have finished. And that is a much better opportunity, because the price is telling you, you know what? We've decided we're going to go this way now. We've decided we're going to put the brakes on the train and we're going to go back the other direction. That's what this tells you here, okay? Read the market, but don't be buying dips while the market is telling you it's going down. Because right now the market is looking right in the face. It's looking right in the eyes and saying, I am trending down. Get out of my way. If you decide to buy into that, it's your own fault.
Getting these huge high volume sell-offs where you can lose a lot of money. So as long as you have a disciplined approach around buying near support so that you can manage risk, I do think you're going to do very well from here. So I just want to be that level-headed voice of reason.
I do want to say, we talked about order blocks earlier, right? Even though these are the best ways that I've ever seen order blocks, or I'm sorry, support and resistance ever work on a chart, there's no guarantee that support holds, right? Support is subjective, okay? Support is somebody drawing a line on a chart and saying, I think price is going to go up from here. Again, like stepping in front of a train track, okay? Order blocks, similar, but they do have data to back it up, right? They do have data saying, hey, there's big orders waiting to get filled. Once it gets down to this area, you could look for bounces, and it's not guaranteed. That's the other thing, right? People think support means it's guaranteed that it's going to come back up. There's no guarantee. It can blow right past your support like it wasn't even there. So just keep that in mind, and always be always risk first, right? So let's give this video a ranking. If I had to rank this out of 10, from forgettable to legendary, I would rate this as a 6, and I'd rate this as a 6 because nobody gets a 7, but 6 because I appreciate him talking about the bond market. I appreciate him talking about keeping risk first, although I don't think he really expounded on that as much as he could have. But I don't like how he's saying there will be bottoms and then it's going to go back up, right? We don't know that. We in trading don't know that. You can hope for that, but we don't know that. And anytime you hear somebody say buy the dip, that person doesn't come from a risk first perspective, because you should never be buying dips. You should be buying on strength. When you're buying on strength, the price is already showing you it's going up, right? I don't want to be buying anything. It's like if you went to the store and you wanted to buy something on sale, right? Let's say you went to the store, you bought a jacket for 30% off. And then a week or so goes by, you're like, you know what? I'm going to take it back to the store and I'm going to make more money on that jacket. So you take that jacket that was 30% off back to the store, and they're like, listen, we marked down that jacket 30% when you bought it, but now it's down 50% because nobody wants it. And we can't even give you back that 30%. We're going to have to give you the refund on only 50%, right? And you're like, what the heck? I just lost money on this, right? I was spending money on it because you wanted this jacket back, right? And they're like, no, we really didn't. That's what the market's telling you. Nobody wants these shares, and there's no reason you should be wanting them to, okay? So tell me in the chat what you're trading. I'd really love to hear, and come back tomorrow where we're going to help you save time, make money, and start winning with less risk together as a team here in the Outlier Trading Room. We'll talk soon.